You're listening to the Inland Talk Express, 1050 AM and 106.5 FM, KCAA Loma Linda.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week that we bring you the information from our studios up here in Ventura County. We broadcasting KCAA Saturday and Sunday every week. We bring you mortgage news, real estate news, information that might help you either decide or not to decide based on exactly what you hear. And as I said, most of the information we give you is topical as well as potentially helpful because of the way the markets go and how things get priced out and whether you can afford it or can't afford it. That is a volatile, changing thing. And, you know, okay, let's just stop for a second and go. I made the mistake of getting involved in watching politics last night. And as I have that kind of stress that everybody has experienced, especially the last 5 or 6 years, anytime these topics go up, what happens is it reminds me of why I don't get involved with it. There's enough stress in life out there for me as a business owner, as somebody who's trying to do loans for somebody who's trying to solve problems that really exist, as opposed to the potential or the manifested stuff that's out there in the sphere of both television and radio and certainly on the internet. So stepping away from that, stepping back to that, I think is great advice for anybody who's trying to buy a house right now. We are getting closer and closer to 7.5% to 8% mortgages. They're on a 30-year fix. That is phenomenal growth in the mortgage rates over the past 18 months. Phenomenal in a bad way. Anybody who's out there who wants to buy as a first-time home buyer who is renting right now, you're in San Bernardino, you're in Riverside counties, you're spending, I don't know, $2,000, $3,000, $4,000 on rent, depending on how big your place is. Rents have exploded. Would you be better served buying a house? Of course you would, especially if you're going to have a family, raise kids, be in that house for 25, 30 years. Of course it's better off owning. Of course it's better off building equity. But it's really tough right now because we have the dual threat thing happening in our world. Rising real estate prices, rising mortgage rates. What does this do to the two-income household who's making $100,000 a year? You can't afford to buy something. Now, that's ridiculous. Of course you should be able to buy something. Unfortunately, this is the kind of market we're in. So what do we need? Do we need the Fed to continue to raise rates so that we eventually have some kind of recession so that prices fall? Well, if you're working and have a job, yeah, you might say yes. But if you're not working, or if you're in one of those kind of jobs that gets laid off during these types of events, you don't want to see that happen. So it's a very, very, very difficult situation for anybody out there who is, looking around to try to buy a house. If you go down Main Street, San Bernardino, Main Street, Riverside counties, or even out into Palm Springs, by the way, that water the other day, how did you fare in the hurricane? Daryl?
I was on the outside edge of it, so it really didn't bother me. The earthquakes really what bothered us here.
Right.
They say that they were 6 miles from Ohio. Well, that's 4 miles from here, okay? So
right.
They're measuring from the wrong place.
Okay, so again, that's another weather-related event that affects property values all over the place. And because we're in Southern California, we haven't had a hurricane in 80 years. We got the double whammy on Saturday.
Well, they say that, when you sign your papers and they say you live in a floodplain, you go, yeah, right. It doesn't matter. It does matter.
Yes, it does. It does matter. And for those, obviously, who experienced all that water, you're right in the wheelhouse of it out there. I think Rancho got, 4, 5 inches of rain? Now, that's a lot of water. And my understanding, listening to talk radio and the news stations, driving to work on Monday morning, every roofer in town had certainly a lot of business that day. There were a lot of calls, and a lot of roof repair needed. And I make light of it, but yeah, it's a serious thing. And it's very, very difficult when let's say you're trying to sell a house, you get your roof leak, now you got to fix the roof in order to sell the house, but prices keep going up, so a little delay is probably going to help you in terms of value on the house. Every month, price goes up a little bit, and that's not a good thing for people trying to buy. For those trying to sell, yeah, that's a great thing. So these are the kind of things that I think about in terms of stressors that I don't want. I already have real stressors out there in the marketplace, and those things are, preying and really leaning on me very heavily in terms of what I'm thinking about when I'm thinking of, okay, how do I help somebody who's making, like I said, two income household making $100,000 a year. So your disposable income, you got 2 kids. You're living in a rental place, probably $2,500 to $3,000 a month. You need the space. You have a car. You maybe have 2 cars. Yeah, it's rough out there, and it's really rough because I don't see a fix for a while. I was on the phone with a guy who runs a company on their sales force, and they lend money to companies like mine, like Malibu Funding, and they're the company that also sponsors this particular show, so thank you very much to those people. NMLS 79620, they lend money to Malibu Funding, and Nate is the guy's name, was telling me that the business is down 30% for them. For the last 18 months. Now I'm thinking 30%. Oh, that's pretty good. My business, the business that I'm Malibu, over 50%. And I would dare say that originators out there who are looking for loans right now are down even further. As I said, we had 7.5%, almost up to 7.8% mortgage rates, according to Freddie Mac last week. We're down back around 7.23% for the 30-year fixed today. But these are really taking all of the fun out of our business as we struggle to stay afloat and struggle to, pay salaries. And, that part of the industry is really suffering right now. The real estate agents are doing great. Anytime they sell, although there's too many of them, right? We went through this a couple weeks ago when we talked about the numbers of real estate agents, the complaints that real estate agents have, the lack of training thereof, and many in the state legislatures who want to up the requirement for being able to get a real estate license, to get a real estate broker license, to make it harder, to make it more like the legal profession or the medical profession, where you have to have a certain amount of training, a certain amount of schooling, and all of this in the face of what the NAR says. No, we have a code of ethics. We do train. Entry level is easier because it seems to be the way that we've always done it. Whatever it is. I don't fall on either side. I'm just saying that as a result of this market, real estate agents are doing well. They're very happy. The real estate commissions are up. As I talked about 2 weeks ago, there's a couple lawsuits winding their way, whatever the word is, through the courts about real estate commissions themselves. If I'm a seller, I'm selling a house. And by the way, if you're out there and you're trying to figure out exactly what this commission structure is and how it affects you, what you get, is there a value-added tax in terms of what you do when you're selling your house? All these things, you need to talk to a real estate professional. Anybody who has got a license as a broker for a long time, like myself, like there's many of them out there, believe me, you can walk down the street, you can spit and hit 5 real estate agents. So there's plenty of these people out there. If you go and you're trying to figure out that particular aspect of it, this commission-based structure where the seller pays everybody 5%. Usually it's about 5%. It used to be 6%, but it's way more like 5% now. And if you're the one company doing both sides of the transaction, probably more like 3.5%, 4%, right? So if you are thinking about selling your house and you want to know, why does the seller have to pay the buyer's commission, the buyer's agent's commission? Well, the 2 lawsuits going through the courts, one got thrown out. It was in Massachusetts. But any court that entertains the changing of the commission structure as a legal point will affect real estate commissions nationwide. It's just the way it works. So they want to be able to separate buyer commission, the buyer pays. Seller commission, the seller pays. Now, will we get cooperation? Will we get the type of information that we need from sellers' agents to be able to represent buyers without having that shared commission based on the negotiated commission that the seller's agent has with the seller. Will that work? We're not quite sure. Anyway, there's a lot of that going on. If you're out there and you're looking for a house, keep looking. Prices, yes, they are high. The cost of the mortgage is high. But keep looking, because we're all waiting for the prices to fall, and we all think they will fall. It's just a matter of when. So you got to be on top of your market when you're looking. Okay, I'll be right back. I'm Jeff Barton, your voice in the mortgage industry. And as I said, we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks for tuning in to the show, for listening to us, for being a loyal audience. I'd never even say that, but this show's been on the air so long. I have people that calling me, writing me. They interact with the show, and I just want to appreciate everybody who does that. It's really nice. If you want to see the show, YouTube, of course, Jeff Barton, The Mortgage Voice. There's also themortgagevoice.com, but we're also on a number of podcasts. I don't know if we have that podcast list available, but...
of course we do, Jeff.
Excellent.
Of course we do.
Excellent. What is a couple of those podcasts?
Oh, we've got Apple Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, podclips.io, and, of course, themortgagevoice.com.
Excellent. Okay, podclips.io. I'll give them a plug because I like those people. That's a central place where you can listen to many different podcasts, whether it's lifestyle or health or sports or business or finance. All these areas, they have a bunch of different professionals who come on and give great opinions, like myself on The Mortgage Voice. One of the podcasts that I listened to recently was about health, and you know what? I took some of the advice and I feel better. So go to the podclips.io. Great place for your centralized hearing of all these different podcasts. I'm Jeff Barton. This is The Mortgage Voice, and joining us once again is Charles Giscombe of United Security Financial, who joins us, talk a little bit about what's happening in the marketplace and also some of the products they might be offering. Charles, how are you?
Great, Jeff. Thanks for having me again.
Thank you very much as well. Tell me a little bit about what's going on in the marketplace. Now we see rates rising again. We see that the Fed is rolling off from their balance sheet a ton of the money that they put into buying mortgage-backed securities as well as treasuries. This is going to put a big crimp on the money supply available for mortgages, isn't it?
I would say so. I would say that the different moves that they're doing are definitely going to tighten up a lot of the available money. As far as the interest rates are concerned, you know, we're all expecting that the interest rates will go up. They'll creep down a little bit, but they'll stay up for the most part. I think the average interest rate for a traditional mortgage right now might be about 7.6%. And that's the norm going on right now for a traditional loan. I'll tell you, a lot of individuals that I speak with are, you know, they're like playing double dutch. They're almost hopping in, hopping out, and they're asking what they should do. I always tell them still, you still should get out there, get involved, get in this market because you can still cut some really good deals. Even though the interest rates are high, everybody's interest rate's going to be high. Even if you got an 800 FICO score,
right,
interest rate's not going to be normally what it was. So I suggest that you get involved. There's so many different creative ways to kind of offset the interest rates in this market, and you should take a look at it. And if a seasoned loan officer, a loan expert can help you with that, that's what we need to do.
Okay, some of the businesses that have been affected, I don't know if you've been watching, but we see Better Homes came back on the marketplace, although they were a company that was almost out of business. They've joined with a public company, but their particular value is down 96%. Guaranteed rate, 2 rounds of layoffs. RE/MAX lays off 7%. These are really industries that attract a lot of different people when times are good. When they're not good, what happens to these people and how do they get qualified for anything on the purchase front? I'll never know. But because the rental market is so, it's so expensive to rent a house as well. Very tough time for this industry. How are you weathering the storm at USF?
Well, you know what? At the end of the day, like we said, people are still going to buy houses. People are going to still transact. At the end of the day, if you can just sit down and speak to individuals and let them know that the interest rates are not what they were 5 or 6 years for the 5 or 6 years. But prior to that, this is what the interest rates were and higher. You have to always remind and give a little bit of a history lesson to individuals to let them know that the market was here before. Now, what we have to do is we have to basically just say, okay, since the economy is in flux, or people are thinking that things are going to change, a lot of things are happening. You just have to basically sit down, talk to the individual, and let them know you're not going to get the best interest rate. We know that the media is letting us know that things are changing. But I swear to you, at the end of the day, I always just tell people, you don't have to stay in anything permanently. A lot of times, if you're getting into these situations, just know that it's going to get better. There's a better side out of it. Create your short-term strategy against your long-term strategy, just to know that once you get in something, if you really need something, people need to buy. You know, we have programs or down payment assistance programs at USF that allow people to get into get 100% financing. But I tell them the interest rates aren't going to be the best right now. They're going to be high. But the strategy should be for the short term that we will get you in, satisfy the need that you have for you and your family. When the market corrects itself, we can go back in with no penalties, refinance you down back to an interest rate that you and you're comfortable for. As long as you are able to intelligently tell your clients that this is a strategy that we will utilize for the short term, and I think that you'll be better off, and them understanding that there is a plan, initially, and then an exit plan to get you into a more traditional, more lower interest rate loan that they can be happy with and get fixed with, Jeff.
Okay, that down payment assistance. Now let's just get into a little bit. Well, we have about 4 or 5 minutes left. Down payment assistance program is interesting because there are some of these programs, and you just mentioned it with USF, that you could almost get into the property with 0% down.
Absolutely. The program that we have is a program that will allow you to get, let's just say for a FHA loan, it's only 96.5% that the finance will provide. You have to come with 3.5%. We have a down payment assistance program that will give you the 3.5%. They'll do it for FHA loans, which are government loans, and we'll do it for traditional loans. And in some cases, if people can qualify, what will happen is we can give them 5% down, which will allow them to actually pay for the down payment and a 1.5 or 2 points toward their closing costs, Jeff.
Yeah, no, that's a great loan. And where do you see that as most popular? Through FHA? Is it a standalone kind of loan? Like a conventional?
You know what? We get it for both. You get it for traditional and you get it for FHA. The beautiful thing about this down payment assistance program, as opposed to others, is that if you stay in the loan for 3 years and 1 day, it's non-recourse, meaning you do not have to pay it back.
Oh, that's great. And so is there a loan limit or special qualifications for it?
You know what? Your income situation, based upon your income, you qualify for FHA, and you qualify based upon what your income limits are. That's how you qualify for the down payment assistance program. Anybody can apply for it, but you have to have a certain minimum of financial means, and then they will give you the assistance and help.
Okay, and these guidelines that you have for this type of program, they're not as harsh as some might think. Like some people would say, hey, that income is like ridiculous. You have to make less than $20,000 or something. No, it's not like that, right?
No, it's not like that at all. You should be making a good income, a decent income, based upon where you live at. A lot of times if you're living in a place where the cost of living is higher, you might not have that money to get into it, right? And so you need some help. And the loans will go up to the loan limits in whatever particular area that you're in. The beautiful thing about this situation is that a lot of people, Jeff, and I understand this about a lot of our clients and borrowers, even at Malibu and over here at USF now, the bottom line is there's a lot of people that pay rent. They get enough means and they make enough money to take care of themselves on a monthly basis. But the hard piece a lot of times is individuals, when they're going through their life and life keeps lifing, they can't save money.
Right.
So where an individual can pay monthly, pay rent, pay all their bills, still have good credit and keep paying, but it's just really hard to get a nest egg or to build a savings. Down payment assistance program is perfect for those individuals because they're already paying on time and already paying monthly. So they're in a habit of making their payments. They just don't have the ability to stock up a lot of money to put down for a down payment. But some of these individuals, they make a lot of money, and if they're in a high-cost area, monthly, it just costs a lot of money. So the
Right.
down payment assistance is not just for people that don't have. It's for individuals that are making money, but still you might be in a high-cost area. It may be very difficult for you to save money because whatever's happened, because life never stops. It's relentless. That's why you still can, and this is a program that will still allow you to get into your home, to get into houses, to get into investment properties, whatever you need to do, and get in there and get some assistance from yourself. The interest rates might be a tad bit higher, but it's a great value-added service for individuals who can't save or don't have that nest egg to put down.
Yeah, I love the DPA program. I really do. I think it's a way by which you can, sing. And you know what? We've seen a lot of banks jump into it. So I'm glad you announced that today, that what you're doing, or not announce it, but at least talk about it. Listen, I'm up against it. If you could tell people how they can get in touch with you for one of these great DPA loans, that'd be great. Are you there?
Absolutely.
Yeah, thanks.
Yes, I'm here. Yes, you can reach me at same old 702 number, 702-328-5191, 702-328-5191, or you can reach me at cgiscombe@usfwholesale.net. That's cgiscombe@usfwholesale.net.
Excellent. Thanks, Chuck. Thanks very much for coming on. I really appreciate it.
Thank you for having me as always, Jeff.
Of course. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show, for listening to us each and every week as we come on and come to you Saturdays and Sundays. You're driving around, you're going to church, or maybe you're down at the hardware store, you flip it on, and you go, oh, yeah, that's that mortgage guy that talks about mortgages. There's lots of opportunities, even in a market where we have ascending rates, even in a market where we have ascending real estate prices, and all these things really. That's what we try to address here on the show, so thanks for tuning in. If you want to see the show, we're on YouTube. Jeff Barton, the Mortgage Voice, is on YouTube. Hundreds of shows there, and certainly we try to keep it updated ASAP. TheMortgageVoice.com, yes, that's my website. You can go there as well. Some of the guests that are on the show are on that site. We have a number of them. You can contact them directly. We try to let you be able to go direct to them rather than come through me as the filter. Anything that we can help you out in this area, we're going to do. Joining us for the first time is Jordan Threet from Next Us Lending, who has been a partner with Malibu Funding, the company that sponsors the show, for a long, long time. Anyway, he joins us now. Jordan, how are you?
Doing fantastic. Thank you so much for having me.
Okay, excellent, very much. Next House Lending, tell us a little bit about your niche, where you're located, what are some of the highlights, especially in the market I just described.
Okay, absolutely. So Next US Lending, first off, this week we have actually rebranded into Brokers Advantage Mortgage. So tons of exciting stuff coming from us. We are specifically wholesale non-QM, with a plethora of programs for all of your self-employed borrowers, as well as any kind of alternative jumbo. And we're also the investor on an awesome second mortgage product that I'd love to talk to you guys about with today. Perfect for this market where you're having a lot of people who have a low first rate,
Right.
want to hold on to that, but maybe need a little bit of equity taken out to take advantage of paying off these, high interest credit cards, or any kind of, upcoming large expenses that they might be having to deal with in their life.
Great. Hey, let's talk about that. Let's talk first qualification, second rate. I don't know if you like to have the first as well as the second, or you do standalone seconds, or you do HELOCs. Tell us a little bit about this product.
So our product is a HE loan. So it's not a line of credit. It's going to be a lump sum of cash.
Okay.
It's perfect for paying off those high interest credit cards. Our product specifically can do owner-occupied second homes as well as investment properties, and anybody with a 660 FICO and above is going to be able to qualify for that product for us.
Okay, look, the phones are ringing already. That's awesome. Boy, that's immediate. As soon as you talk about it, phones start ringing. Okay, so this is obviously a very good product, especially as you described. Look, we got 3% interest rates out there. I mean, we got another 20% equity in the house. How do I take advantage of that? And this seems to be the product. What are the rates that you start at? And are they adjustable rates? Are they fixed? How does it work?
So for ours, you have a multitude of different amortization programs. We can do 10, 15, or fully amortized over 30.
Okay.
All our programs are going to be fully amortized. With a 700 score, you can go all the way up to a 90% CLTV, and that would be on a full doc type loan file.
Okay.
But the coolest part is we also offer this as a non-QM lender. We have the advantage of being able to qualify your self-employed borrowers who are taking advantage of, getting to write off of large amounts of, things off of their taxes for their businesses. So they can qualify as well for this program on our bank statement program, all the way up to 85% on an owner-occupied program. As far as rates are concerned, obviously it's going to vary a lot depending on your CLTV, so your first and your second combined LTV in the home. But they're starting as low as 9.5%, and it kind of goes up from there depending on situations. And it's a great opportunity for people, especially on that bank statement that might have a lot of options.
Okay, so a scenario that comes to mind immediately. I got a 3%, it's a 30-year fixed, I got equity in my house, I go up to this 90% because I have a 700 FICO score. Let's say the rates drop in a couple of years, even your second's rates drop. Do they have an opportunity to refi just the second, or do they have to refi the whole thing? How does that work?
So if they're doing the refinance, that's an interesting situation. They have the option to refi everything totally. Obviously, if rates come down, and they can combine the first and the second with whoever is going to be sitting into first position lien. There's no prepay penalty for these products, even on non-owner occupied. A lot of times these are great opportunities for people with DSCR loans that are sitting there and they have a really low rate from maybe 2 or 3 years ago, and they don't have to worry about a prepayment penalty, which is one of the greatest aspects of this loan.
Right. No, I like that. I like the fact that there's no prepayment penalty. I like the fact that you've got a little bit on the high side, in my opinion, 90% up to 90% you take out. Do you have a loan limit dollar-wise, or is it just the percentage?
So 2 limits to take into account are going to be your max combined lien.
Okay.
The max combined lien for first and second is going to be maxed out at $2.5 million.
Okay.
The total loan amount that they can receive is $550,000. So those are also going to be, in conjunction with the credit in coordination with the LTV for the home.
Okay, so underwriting. Now, you've rebranded the company. Do you still have the same underwriting and same people looking at each loan, or how does that work?
Same great process that we've always ran.
Great.
We really try to cater as a white glove service. I mean, customer service and your experience with the AE is what I really think makes your entire experience at any lender. So we really try to go out of our way to, be hands-on, always communicating, and, knowledge of the products, I think, is one of the most important aspects. But right now, our rebranding is changing into Broker's Advantage. And as we move into the next couple of months to several quarters later, we're looking to expand different kind of products. We're looking to expand into, more markets and being able to access more borrowers and be able to solve more borrowers' situations with what they need.
Now, interestingly enough, we always talk on this show about, the availability of money, who you're backed by, maybe where you're selling these loans, because I know there's a lot of companies out there that are really fretting this high interest rate market because they did jumbos at 3%, and they got a whole pile of them that they can't get rid of, can't do anything with, and those particular lenders are in trouble, not unlike, what we saw early on when we had the shift from a low interest rate environment to a high interest rate environment. What is the backing that you all have, and what are you doing with these loans?
So we're a very highly capitalized company.
Okay.
We're one of the more profitable companies in the sector. We resell really strong loans. So from a basis of being in the market, we're extremely well situated to continue lending.
Okay.
So that's definitely a huge benefit for us on that side. And on the resale market, we really have a select group of buyers that we choose to work with very, very closely with. And we're backed by a very large hedge fund, so we have plenty of capital to continue funding these and continue to do them at great rates. As long as we're hitting the buckets as far as LTV and credit is concerned, we're going to be here for the borrowers for as long as we possibly can be.
No, but yes, I know your company has been around a long time. I've been, as I said, been doing business with them for some time, and I like the rebranding. I like Broker's Advantage. It caters to the wholesale market more directly rather than Next US does, because that's more of a national sort of branding. This sounds like you're in partnership with your local people who are doing the originations, which I always like because I think that model works really well.
Yeah, absolutely. I mean, relationships are the biggest
right.
key in this environment. So the more we can do to showcase the quality of products that we have, showcase experience, and we're just excited moving forward as Broker's Advantage to continue that trend of that white glove service and, continue to give the best options and best rates possible for whatever we're markets in. And I think it's interesting when you mentioned about moving into a higher interest market because, it's all relative, right?
Sure it is.
A few years ago, we're having a lot of competition at 4%, then we're moving to 5, 6, and 7. So, kind of wherever the market is, we're doing everything possible to stay competitive and, be here for all of our brokers. And, the most important thing is that we get the loan closed, right? So
that's absolutely right. And offer these programs, continue to offer choices, even though the customer may say, hey, it's really high. You go, well, historically, no, it's not that high.
Right.
Historically, we're right in the middle of the ball game. So,
And there's two great ways to sell this loan. We have also a website that brokers are able to take advantage of called blendedrate.com.
Okay.
And that gives you the opportunity to showcase the first lien versus the second lien, because sometimes obviously those higher rates are going to be a little bit more prohibitive when you're talking to the borrower to sell them. But if you can showcase that the 3% they have on the first in conjunction with the second that's going to be at that higher rate,
right.
It's still putting them at a rate that's under 5% combined, or 6 or 7. It can really be a nice way to sell it. But at the end of the day, this is a strong asset solution product. You don't want to be paying minimum payments on credit cards and this continual rotation of staying in debt. And this gives you an opportunity to have a fully amortized product with a consistent payment that's going to give you the opportunity to get that debt out of your life and be able to move forward.
Excellent, Jordan, and well said. I really appreciate that. We run out of time. Want to have you back on. That was a pretty good explanation as to your product. If you could, would you let people know how they might be able to get in touch with you directly?
Yeah, absolutely. My name, again, is Jordan Threet. You can contact me at jthreet, that's JTHREATT, at brokersadvantage.com. You can also give me a phone call whenever on 949-748-8046. Again, that's 949-748-8046. And we also have a plethora of first trust deeds. Bank statements are a huge part of our company. So if you have any issues for anything not fitting conventionally, please give me a call. I would love to be your go-to for anything outside of your conventional box in the non-QM world.
Jordan, thank you very much. I really appreciate you coming on the show.
Yep, absolutely. Thank you so much for having me, guys. I really appreciate the opportunity and look forward to speaking with you again.
Excellent. I'm Jeff Barton, your voice in the mortgage industry, and that was Jordan Threet from Broker's Advantage. Great new addition to the rotation. Really appreciate it, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Really appreciate you listening to the show, and thank you very much. If you want to see what we're doing on a weekly basis, go to YouTube. Jeff Barton, the mortgage voice. That's who I am, and that's the name of the show on YouTube. Hundreds of shows there. We have a trend line on the show that we talk about rates and why things happen let's say the last 18 months, and each and every week we have a color-coded chart that we don't have any of that. But if you do want to see and hear the show, go to YouTube. It's excellent. Also, if you want to hear and see the show, we have a number of podcasts that we're on. Daryl, do you have a list of those podcasts?
I sure do, Jeff. We're on Apple Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and themortgagevoice.com.
Okay, Podclips.io is a great place where you can centralize all of your podcasting needs. Go to Podclips.io, and you will see and hear a number of amazing people that you can both learn a lot from and be entertained by. That's Podclips.io. You know, I give them a plug every week.
You sure do.
I hope they're just, swimming in all the leads that they're getting from people who want to listen to the show. I hope they're doing well.
I produce another 3 or 4 programs over there, so I'm happy that you do. Thank you.
Oh, excellent. Perfect. Okay, so as we are in the last segment of the show, I wanted to bring to the show to you once again Connie Hernandez from PMA. She joins us now from West Covina. Connie, how are you?
Fine. Thank you for having me, Jeff.
And thank you, Connie, very much. You've been such a loyal guest on the show, and the information that you bring is so valuable, especially not only in the local markets, but also give a flavor as to how the process works with professionals, because so many people just don't know.
Well, I'm always happy to help answer anyone's questions regarding the process and, any other questions that may be of concern.
Yeah, product-wise, I think we're in a situation where a lot of products in the marketplace tend to speak to those who are not regular W-2 earners, people that are out there in the business world who need a loan. Interest rates are a little higher, but it's tough to pitch when we've been at 3%, 8% or a 7.5% loan on a 30-year fixed. Do you find that true?
To be quite honest with you, Jeff, I don't know if it's because it's tapered down a little bit from the expectation of rates going back to what they used to be.
Good.
I would say in the first 6 months was really difficult to even wrap your head around these types of rates. But I think the reality has set in for a lot of people. And to kind of share a little bit with you, you're absolutely right. For a little bit there, what we were focused on and what we were doing quite a bit of was really focusing on self-employed people that were used to paying the higher rates, and it's just now a little bit higher than what they were used to. And, they were used to, now a lot of people are doing cash-out refis.
Right.
So they're using the HELOC options, the second TD options, and now we have some lenders that are actually offering thirds. Sometimes those are, if the equity's there, right? I mean, because you have to remember, a lot of these people have paid down their loans substantially over the years.
Right.
And they may have traditional HELOC from their lender, and they don't really want to touch that. And now there are actually people out there offering third TD trustees.
Wow.
So that's kind of an option there if people want to leave their HELOC alone, but they need maybe a loan to maybe do some remodeling, pay off some debt, but they don't really want to either use their HELOC for whatever reason because those rates are adjustable, and they don't want to give it up either. They don't want to close it. But with that being said, you're absolutely right. The market has definitely taken a turn. I do have trickles, and I do mean to say that honestly, trickles. Okay. Trickles of business of people that obviously are higher income earners, still on a W-2, that feel that this is a younger generation, by the way. We're talking about, from mid-30s to maybe early 40s.
Okay.
That are career-driven young couples that both work, and they realize that if they're going to own a home, that they're just going to have to come to the realization that they're going to pay $800,000 for their home, and they're going to pay a 6 to a 7% interest rate, and they're doing it with the expectations that they are actually a little bit more financially capable than I think some of the clients that we were working with. Because you have to remember, I think a lot of certain generations have either were able to either advance in their careers and now they're making a bit more money,
right,
and or they were at home with parents and were able to save money for the last 5-10 years.
Right.
I can speak that from personal experience.
That's funny. Funny you say that, not because it isn't true, but just because, I hadn't even thought about it like that. But of course, there's a lot of people who have stayed at home, saved money. Now they can go out and buy a house with a down payment.
Yes, as a matter of fact, again, personal experience. My son has stayed home for 10 years, and because obviously he's at home, not paying these outrageous rents out there, he's able to save close to $80,000. So that gives him a comfortable down payment, versus the clients of maybe 10 years ago, where they had a good job, but they had 3 or 5% down to work with.
Right.
So I think that's where there's a bit more opportunity for us to kind of look for those particular clients. So there's still clients out there. They're just not they're not as what should I say, as numerous as before.
Yeah, no, I think that's true. And I think rising real estate prices are really you can take a rise in the interest rate, but if you double that up with a rise in the cost of what you're going to buy, that's hard. And you really have to project out, like you say, young professionals, that two-person home, both people working. Yeah, you might be able to say, okay, we can afford that. But how many of those are out there? I think there are a lot of traditionals where one stays home and watches children and the other is out working. I think that there's still a lot of those people, and it's really tough to get them to understand, what they can afford, because I don't think they can, unless they go way up to 15.
Well, Jeff, something that I've come across quite a bit, not as often as before, but I'm finding that people are actually kind of joining forces to purchase a property, and with the expectation of doing ADUs on the property once they've acquired the property.
Oh, that's a good strategy.
And I actually did a small course in it, or not, more like a workshop. And it actually turned out really well. I didn't really invite too many people, but I just kind of wanted to get a feel if people would be open to that. And you have to remember, now it becomes a business, right? Now you're in business with another couple or another person, knowing that you're going to convert the house into some type of ADU situation. So you still have your separate living quarters, with the expectations that, once you've built up enough equity in it, you can sell the property and maybe go on your own.
How do you recommend people hold title when they're in a situation like that? Or obviously you don't, because you're a real estate agent. You get them hooked up with either title or some kind of an attorney to figure out how they're going to split equity?
Yes, I ask them to review the options that title gives us. Obviously, it really is specific, because if the two couples have no children, or if the two couples are related, the situations are very different depending on their individual situation. But for the most part, we always recommend tenants in common. We don't really recommend it, but we suggest that they look into that option, and with the recommendation of their attorney and their CPA, to make sure that it's not affecting, their tax liabilities, or nothing that they're not going to be shocked with. And obviously, seek even a title company will answer those questions for them. But I basically provide them with the different options. And if they have questions regarding that, many times I can get someone on the phone that's an expert in that area, and they're not hearing it from me directly, but they are hearing it from someone in title.
That's excellent information. So you talked a little bit about the third. You talked a little bit about this particular way to own home ownership. All really clever ways by which you can just use what you have, but still get in the game. And I think that's the important part of it.
Well, we have shared many years in this business, right? So
No,
we have to become creative for our clients and be able to offer them options.
Yeah, no, I agree 100%. Listen, we're out of time, but I want to give you an opportunity to let people know how they might be able to get in touch with you, and maybe where you're located, things like that.
Absolutely. My name's Connie Hernandez. My direct line is 626-422-2017. Our office is in downtown Covina, right on the corner of Padilla and Citrus, 101 North Citrus Boulevard, Covina, California.
Okay, Connie, thank you very much. I do appreciate you coming on the show, as always.
Thank you, Jeff.
Thank you. That's Connie Hernandez from PMA. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. As we're here each and every week, we try to bring you the best of what is out there is in terms of information and some opinion. Obviously, I've been in the business a long, long time, and I have many, many opinions about what happens in the real estate world, whether it's fair, whether it's right. But most of it is about trying to see if you can buy a house, whether the house is too high in price or whether there is too high in the mortgage rates. Both of these things are going to affect your decisions. If you want to see the show, we have many, many shows online. Go to YouTube, Jeff Barton, The Mortgage Voice. That probably posted hundreds of shows on YouTube, or you can go to themortgagevoice.com. That's our website. Either one of these places you can see, hear, and look to contacting the guests that you do hear on the show. We bring to the show many, many different guests, both people that have been in the business for a long time, account executives, reps, agents, loan officers, people that know a lot about what's going on, and we try to bring to you solutions about programs, what you might be able to afford in this particular market. Let's get right to it. News to use. The 30-year fixed rate loan today, 7.36. As I said earlier in the show, that's high. 6.75 is the 15-year, 6.99 is FHA. 7.35 is the jumbo. You know why? Because nobody wants to do the jumbos anymore. There are several banks around the country right now wishing that they didn't do jumbos at 3%, because within 18 months, if you're holding those or portfolioing those loans, who wants to securitize a 3% mortgage that's a jumbo? Nobody. All of these banks are in trouble because they can't liquidate what they have in their portfolio, which means that, you know, if in fact they want to borrow more money, can't do it. There's not enough collateral in there, and you can't sell it to anybody because no one wants that thing. I can name a few banks that are like that, but you know them. The banks that do jumbo loans. Anyway, they're in trouble. Let's see. The 5-1 ARM is at 7.18. The 2-year is at 5%. 5% on a 2-year. So if you have the ability to get out there and buy treasuries at 5%, you probably get a discount on the purchase price as well. That's a pretty good return. Who wouldn't want 5%? And as a stupid aside, I'm 68. When I was, I don't know, when I had my first bank account, I must have been 11, 12 years old, had whatever money I had from whatever job I had. And back in those days, money wasn't a lot. But my passbook savings account in those days, early 60s, 5%. Unbelievable, right, Daryl?
I had exactly the same thing.
Yeah, exactly. And that was a big deal. And I didn't know percentages from, but if you look at it historically, yeah, they were around there, and we might see even more. Anyway, the 10-year is at 4.229. As you can see, the spread has been narrowing, although we get these fits and starts as to the acceleration and the deceleration of treasuries, of the bonds that they're being sold in the open market. I have a lot of things randomly. We've got the Fed meeting at Jackson Hole. They do this every year, and they come out with their prognostications for the future, as well as a review of what they've been doing, mainly been trying to raise rates to keep inflation in line. Now, we've got inflation certainly a lot less than it was, but stubborn things like food, oil, not oil, I mean gasoline. And it's funny, I say oil. Oil is at about $78 a barrel today. And we see gas prices. I buy not the cheapest, but the medium one. I don't know, what do they call that? Do you know what they call the medium grade?
Extra regular.
Okay, is that what I don't
Plus, I think.
I don't
plus.
know what it is, but my car seems to like the better gas.
It's not Supreme, it's Plus. I think.
Yeah, okay, very good. It depends on the gas station, but there's 3 choices. I usually choose the middle one. $6 a gallon. $6 a gallon. Now, when we were really complaining about gas prices, now you hear it, like I say, you might hear it in a debate, or you might hear it from, your online right or left people decrying the cost of gasoline, and I do it too. But $6 a gallon was when oil prices per barrel were $140. And that was, I don't know, not even that long ago, but it was 3 or 4 years ago. Now we're getting $6 a gallon when the price of barrel of oil is $78. That's half what it was when it used to go. I just think we've been desensitized, to so many things, right? And I think there's not a lot of attention paid to just people who can't pay that anymore. I think one of the reasons is that OPEC sees the writing on the wall, that the oil companies here in the U.S. see the writing on the wall, that electric vehicles are here to stay, and whether it's 10 years, 20 years, 50 years, the electric vehicle will eventually be the dominant car on the road, and maybe the only car on the road. And because of that, you try to, squeeze the last drop of, the last bit of money out of the poor consumer out here who's just trying to get to work. But $6 a gallon of gas, that's too much. But in Jackson Hole, these inflationary raises of anti-inflationary raises of the interest rate by the Fed. Will we continue to raise rates, or will we be done with that? There's always the reverse thinking on all this. If you psychologically hold the line, your stock market's going to do better. Why? Because you think they might be stopping raising rates and maybe even lowering rates at the end of next year, especially if the economy stalls, right? That's what the psychology of it is. But the Fed has another trick up its sleeve. It's not a trick. I say that because it's something I'm saying. The Fed has a balance sheet which is roughly $4 trillion, $5 trillion, $9 trillion. I don't know. It's enormous, because for all those years that they were buying mortgage-backed securities and buying treasuries as part of the quantitative easing, making it so that borrowing, making it so that there was still a market in both of those entities, in treasuries and mortgage-backed securities. Well, they made their balance sheet so big. So if they start to let these securities, what they call, roll off the balance sheet, meaning that they mature, you pay them off and they're done. That is also going to suck up the money that's in the system in order to have that to be able to be done. That's what's going to happen. And so you're not going to raise rates, but you're going to keep borrowing tight and the money supply short, because treasuries are being either sold or rolled off the balance sheet at the Fed. This is the other thing that we haven't talked about in a while, because there's been such a raise in short-term interest rates. It's almost a shocking raise to the system. Now, you're out there and you're trying to figure out how you're going to pay for a mortgage that you want to get on a new house costing $750,000, and you can't really factor in why it is that the banks have gotten tougher in terms of approving you. The mortgage companies are pushing you into products that you might not necessarily want to do, because the interest rate is over what I've quoted it here at 7.36% today on a 30-year. But because you can't match the criteria of that particular loan, you have to get pushed into a non-QM loan. Now, these are good loans, but the interest rate's higher. So can you really afford it? I don't know. That's the problem with what the Fed does when they don't raise rates, but they roll their mortgage-backed securities and their treasuries off the balance sheet. Now, obviously, the Fed can't run around with a $9 trillion balance sheet. That's not good for anybody. And we tend to forget that that's what happened and got us through the really bad times and kept interest rates at 3%. We're so quick to forget. I was thinking today that it was only 8 years ago that Barack Obama was president. Doesn't it seem like 100 years ago?
It seems like it was last century.
Yes, exactly.
Man.
And I'm not saying that was good or bad. I'm just saying we lose track of what's happening right in front of us. Hillary and Donald Trump were in 2016. That was 8 years ago. It's just unbelievable. To almost 8 years ago. It's truly amazing how we get so hyper-focused on the moment that the historical look at things or even the history of, the last 10 years, it just doesn't consider in anything that we're thinking about or wanting to do.
It falls away.
It's amazing. Okay, new home sales increased to 714,000. That's a direct effect of lowering the inventory. Inventory is low, and therefore we sell more new homes because that's the only thing on the market. I got a lot more to say. Hey, I'm Jeff Barton, your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Miss your favorite show? Download the podcast at kcaaradio.com.
Tehibo Tea Club's original Pure Pau de Arco Super Tea helps build red corpuscles in the blood which carry oxygen to our organs and cells. Our organs and cells need oxygen to regenerate themselves. The immune system needs oxygen to develop, and cancer dies in oxygen. So the tea is great for